Hello, Dr. Cardona. I could not for the life of me figure out how to put my voice on a screen recording. So I'm just going to send this voice over and kind of walk you through the 3-slide PowerPoint, and hopefully that will do. Another side point is that my slides kind of hop around to different points because obviously I only prepared what I prepared for the Wednesday discussion. So other students in my group are going to cover the other parts. So that's why it might be hopping around a little bit. But today we'll be talking about the dynamic correlations among asset classes of REIT and stock returns. In slide 1, the results from the study suggest that REIT stock correlations formed 3 distinct periods. In the first period, it started in about 1972 and ended in 1991 with the beginning of the modern REIT era. Correlations in this period were high and without trend, always above 59%, hovering around 65 to 66 mostly. And then in the second period, which started in 1991 and ended in 2001, was the inclusion of the REITs and broad stock market indexes. And during this period, correlations declined to about 30%, but this substantially increased higher portfolio allocations to both high return asset classes and therefore higher portfolio returns without increasing the portfolio volatility. So it was a very important period. And then going on to the third period, which is about 2001 to 2008, correlations slowly increased and reached about 59% in 2008. Okay, now we'll go over to slide 2. We're just going to talk about the 3 techniques that economists use to investigate these correlations among REIT stock correlations. So the first approach that they talked about observed dynamics in beta to examine the effect of including REITs in broad stock market indexes. So the first study they talked about was Fang in 2006, and he computed REIT beta relative to the S&P 500, looking at daily returns for the year before and after the inclusion of REITs. And he found that beta increased by a lot. And then the second study proves true as well, kind of backing that up. Ambrose in 2007 also looked at beta before and after the inclusion of REITs, looking at both daily and weekly returns, and he found the same exact result. The next technique was the rolling correlation coefficient, and that's basically looking at the correlation among a longer period. And it also compares equity REITs, mortgage REITs, and S&P and the broad indexes like S&P 500. And most of them found that it generally declined in the stock market between the periods of 1972 and 2001. Barry and Olson found that one. Conover did a 12-month rolling correlation, found the same thing, and then Chen in 2007 found he did the longest 60-month correlation between equity REITs and the broad index and found the correlation declined as well. So the final technique that we're going to talk about is the multivariate Vargark, which is a technique to examine the daily return and volatility among relationships. Volatility relationships among REIT property sectors and REITs and stocks. One of the studies that talks about for that was the Cotter and Stevenson that found that daily conditional correlations fluctuated widely, but would generally trended upward during the study. That period was about 1999 to 2003. And then finally, what the technique the study actually used was the dynamic conditional correlation multivariate GARP model. And this was used to gather more than 35 years of monthly data from 1972 through 2008. And now we're kind of going to jump to the last slide here and just going to talk about what to take away from this study. This is the same exact slide that was on our group presentation, just so you know if it looks familiar, but one of the other guys took it over for me. But yeah, this study proves how well of a measuring tool the DCC GARC model is for examining dynamic conditional correlations among asset classes and other variables. It kind of took me a little bit to dive into the second point because it took me a minute to realize what it meant, but it proves to be more efficient and less volatile than a rolling model, as the realized returns of the DCC GARC beat the rolling model of asset covariances by 20 points. So I was super confused, and what this actually means is it suggests that investors and portfolio managers would be more willing to use this method because it offers more efficient and trustworthy data, and that's kind of what the point of the paper was. So yeah, I'm going to wrap up before 5 minutes, but I hope this makes sense and wasn't too confusing with me hopping around. But yeah, thanks. Have a good one.